Hello everyone and welcome to Financial Accounting. In this video I will be going over chapter 13 that covers statement of cash flows. So the statement of cash flows is very similar to the income statement. The only difference, it only focuses on cash flows. It doesn't really care about whether revenue is accrual or cash. It only focuses if the revenue is cash, it's an inflow. If the expense is in cash, then it's an outflow. So we don't really care whether we provided service or not. The main focus is what we really think about whenever we are thinking in terms of cash, which is how much cash we received and how much cash we paid. And they divide this into three sections. We have the operating section, we have the investment section, and we have the financial section. So these three sections within the statement of cash flows are the main three sections that we're going to learn in this video. So again, the statement of cash flows reports a company's cash inflows and outflows for a period. Inflows is whenever we receive cash, outflows is whenever we pay cash. The statement of cash flows provides useful information about a company's ability to do the following: generate cash from operations, maintain and expand its operating capacity, meet its financial obligations, and its ability to pay dividends. So the statement of cash flows is used by managers in evaluating past operations and in planning for future investments and financing activities. It's also used by external users such as investors and creditors to assess the company's profit potential and ability to pay its debt and pay dividends. So as I said before, the statement of cash flows reports three types of cash flow activities, which are the three main sections of the statement of cash flows. We have the cash flows from operating activities, we have the cash flows from investing activities, and we have the cash flows from financing activities. For the operating activities, these are the cash flows from the transactions that affect the net income of the company. So anything that has an impact on how much income we make in terms of cash received and cash paid, then would be appearing in, or should appear on the operating activities. So for example, purchases and sale of merchandise or inventory by a retailer. On the other side, cash flows from investing activities, these are the cash flows from transactions that affect investments in the non-current assets of the company. To be more specific, things related to property, plant, and equipment or fixed assets. So purchase and sale of fixed assets, such as equipment and building, would fall into this category. So if we're buying equipment, that, like the cash paid, is going to be appearing in the investing activity section. If we sold an equipment or sold, let's say, a building or land, in this case, again, the amount of cash inflow that we receive in exchange of this kind of transaction would appear in the investing activities. Now the last section is the financing activities, and cash flows from financing activities are the cash flows from transactions that affect the debt and equity of the company. So for example, issuing or retiring equity and debt securities would fall under financing activities. To simplify that, anything related to long-term liabilities or anything related to equity, like issuing more common stock or retiring a bond, or even something like issuing or paying cash dividends, that would fall under financing activities. So the cash flows are reported on the statement of cash flows as follows. We have cash flows from operating activities, then we have cash flows from investing activities, and then cash flows from financing activities. These are the three areas of the statement of cash flows. Then we get the total of these three sections, and we call that changes or change in cash. Then we get this change, we add it to the beginning balance of cash, where we can get it from the previous balance sheet, and that will give us the cash at the end of the period, which should match what we have in cash in our balance sheet. So it's a good way to reconcile with the balance sheet to confirm that the cash balance is correct. So the ending cash on the statement of cash flows equals the cash reported on the company's balance sheet at the end of the year. A source of cash causes the cash flow to increase, and it's called a cash inflow. A use of cash, or in other words, when we're spending cash, this causes cash flows to decrease, and it's called cash outflow. So here are some examples of cash inflows and outflows for operating activities. An inflow would be from sale of product, from providing services, and an outflow would be purchasing inventory, paying employee salaries, or paying taxes. For investing activities, that's somewhat related to long-term assets and property, plant, and equipment, or fixed assets. So that would be from sale of property, like an inflow would be sale from property, plant, and equipment, or from sale of investment. And an outflow would be to buy property, plant, and equipment, or to purchase investment. And for the third category, financing activities, the inflows would be from issuing long-term liabilities or issuing stock, and the outflows would be to pay dividends or shareholders, pay dividends to shareholders, or to purchase common stock like treasury stock, or to repay long-term liabilities. So let's focus again on cash flow from operating activities. And one thing I want you to understand that there's two ways to present the operating activities section, and that only applies to the operating activities section. The other two sections, the investment and financing activities, we only have one way to prepare it. So for the operating activity, the two ways are either the direct method or the indirect method. So as it says here, cash flows from operating activities reports the cash inflows and outflows from a company's day-to-day operations. Companies may select one of two alternative methods for reporting cash flows from operating activities on the statement of cash flows, and that could be either the direct method or the indirect method. These two methods should lead to the same result. So both methods result in the same amount of cash flow from operating activities. They differ in the way they report or present the cash flows from operating activities. But again, there are two approaches for the same result. So the direct method reports operating cash inflows, the receipts, and the cash outflows, the payments, as follows. So it's very straightforward, it's direct, so you should expect to see the inflows and the outflows as cash payments and cash collections. So the cash flows from operating activities would have cash received from customers, cash payments for merchandise, cash payments for operating expenses, cash payments for interest, cash payments for income taxes. And you can see that without the parentheses, these are inflows. With the parentheses, these are outflows because they're going to reduce your cash balance. We add all these kind of different levels of cash receipt and payment, and you get the net cash from operating activities as a total here. The primary operating cash inflow is cash received from customers. The primary operating cash outflows are cash payments for merchandise, operating expense, interest, and income tax payments. The cash received from operating activities less the cash payment for operating activities is the net cash flow from operating activities, which is this number. If our receipt from customers are more than our payments for these other things, then we'll have a cash inflow, a net cash inflow. If our receipts from customers is less than the cash payments that we made for these other things, then we'll end up having a net cash outflow. So the primary advantage of the direct method is that it directly reports cash receipts and cash payments on the statement of cash flows. Its primary disadvantage is that these data may not be readily available in the accounting records. Therefore, the direct method is normally more costly to prepare, and as a result is used infrequently in practice. So in real life, most companies, they prepare the indirect method. And what's really interesting, generally accepted accounting principles says if you use the direct method, then you have to support it with the indirect method. So you'll have to end up doing the indirect method anyway. So because of that, for the operating section or the operating activity section, we're going to focus on discussing the indirect method in more details, which we'll be doing in the next video.